Okay, so this afternoon we are starting a series on candlesticks pattern, right? And um, this is going to be theory aspect of it. So I'm going to tell us some things about candlesticks pattern. And you see, a whole lot of traders have been trading. They don't understand what candlesticks pattern is. They don't understand how to trade candlesticks and all that. Do you understand? So this class is for you. And I'm going to simplify two things. What candlestick is, the history of candlesticks. Also, I'm also going to explain some candlesticks formations, what you need to know. And on Friday, by God's grace, we are going to do the practical aspect of it. Okay, so that is that for the candlesticks. So sit tight and be very much attentive because I know this class is going to be um extremely interesting and insightful for everybody. Okay, so let's get started. Okay, now what is candlesticks, right? And how does candlesticks come into play? So candlesticks charts are believed to have been in existence since the 18th century, during the time of Japanese rice future traders. There's a man, his name is Monisa Homa. He's called the father of candlesticks, right? So this man uses candlesticks to represent every monthly activities in the market. So he's a rice trader, he's a rice farmer. So in a month, let's say in January, if he make good sales, he's going to use a block, right? He's going to use a block, right, as an example, right? Then in another month, if he's not making good sales, like previous months, he's going to reduce the block, right? So that was how he has been doing it in the 18th century. Okay, so there are two types of candlesticks. There is a bullish candle and there is what? Bearish candle, right? So what does it mean? It is gotten from the attacking nature of a bull. If a bull wants to attack, what does it do? It takes you from down and what? Throw you up, right? So this is called a bullish candle, meaning that, right? Meaning that it opens at the lower price, right? And closes at the what? Higher price. So it doesn't matter the price. Even if it opens at 1 and closes at 2, it is still a what? Bullish candle, okay? Because it represents that it's going up. So a lot of people just, for graphical representation, for much understanding, what they do is they use candle coloration. Okay, so they use candle coloration. Um, you know, that is what they do. They use candlesticks coloration. So you think that you think, oh, okay, green candle is bullish. No, bullish candles start from a what? A lower price, like it's opened at a lower price and closes at a what? A higher price. That's why I call bullish candle. And they are gotten from the attack nature of a bull, right? While bearish candle is the opposite. If a bears wants to attack you, it takes you from the top, right, and draw you down. So it means that it opens at a what? Higher price and closes at a what? Lower price for each session, or we can say time frame. Okay, so in different time frame we have 1 minute, 5 minutes, 10 minutes, 30 minutes, and all that. So if you're in a 1 minute time frame, it means it takes 1 minute for a candle to do what? Open and close. If it's 10 minutes, if it's 30 minutes, it takes what? 30 minutes for one candle to what? Open and close. So when a candle opens at a higher price, let's say it opens at 3 naira and closes at 2 naira. So it's called a what? Bearish candle. Okay, so bullish candle is always common in an uptrend. Bearish candle is always what's common in a what? In a downtrend. So those are the two types of candlesticks that we have, right? So let's continue. Now, just another example is just a graphical representation of global market activities as it's being controlled by forces of demand and supply. So it depicts the pressure of what buyers and what sellers. And we all know that demand happens when there's an increase in price. That is when price keep going up. So it means that when price opens at 5 naira, and closes at 10 naira in the session, the next candle opens at 10 naira, closes at 20 naira, you know that the demand is high because more buyers are coming into the market. And supply is much when we can see that the price open at 20 naira and closes at 10 naira, the next price opens at 10 naira and closes at what? 5 naira, right? So those are, it means that sellers are coming down in the market. And one thing people don't understand is that sellers are the one responsible for market dropping, why buyers are the one responsible for market what pushing up, right? So now there are two things in the market, right? In the candlesticks, right? So I'm going to explain. The first one, it's the thin lines. These thin lines, they are called wicks or shadows. Okay, they are called wicks. WWICKO. Sorry, let me use it as a text. So they are called what? Wicks or shadows. The thin line is called what? Wick or shadow, right? While So what does the teller represent? They are places where the price has gotten to before, right? They are places where the price has gotten to before moving down. So we have two types of shadows or two types of wick. We have the upper wick. So the upper wick is where price get to, let's say price has gotten to 10 naira and it started going down to probably 6 naira before it closes. So it will just show you the representation of the thin line. So when you're seeing the thin line is what upper wick, and the lower wick showing you uh, from probably market opens at it goes to probably 4 naira and goes up to probably 6 naira, right? So the lower wick. So we have the upper wick and the what? The lower wick. So this place, go back, then that's the lower week. This place come down. That's what upper week, right? Then the distance between the open price and the close price. Don't forget, the open price and the close price they determine the body or the type of candlesticks. So if a candle opens at a low price and closes at a higher price, it is called a bullish candle, right? But the distance between both this and this is called the what? The body, right? Same thing as this. When the price open at the higher price and goes down. So let's say this price opens at 20 naira and goes down to probably um um 15 naira. So it's telling you that this price, this high is where price has gotten to in a particular time before it moves down. And if price gets to probably 7 naira and rise up to 8 naira, it's telling you that what price has gotten to 7 naira what before. Then the open price recorded, market records its own open price. So if the open price is high and the closing price is low, right, it's telling you that what that is a bearish that is a what is a bearish candle, right? Do we understand? I hope I'm not too fast. Okay, so let's continue. Okay, so this is just the historical footprint of candlesticks pattern, telling you that when it started, it's originated from what? Japan in the Edo period, from the 16th century to the 1868 century. Don't forget I said that Mr. Monisa Homer was the one that what? Mr. Homer was the one that discovered the candlesticks, right? He was using blocks to represent them, right? Now, so it's from 16th century to 18th century. That was when candlesticks has been in existence. So for some of it are just looking at how old is the market is centuries old, millennia old, right? So you can see this is a good example. So, what are the three reasons of using Japanese candlesticks? The first one is for visual dynamics, right? So, visual dynamics in the sense that you'll be able to see what is happening in the market. Just like what I said, that bullish candle is for when market is going up, right? Bearish candle is when market is what? Coming down. Then we have precision timing. Every candlestick is reflecting on each time frame. So, one time frame to what? To another. Then we have enhances technical analysis. With candlesticks pattern, you'll be able to see a good technical analysis. It helps your technical analysis function very, very well. So these are the three key reasons why you use candlesticks pattern. Number one, visual dynamics. You'll be able to see clearly what is happening in the market. Number two, position timing, because every time frame, every candlesticks, it takes, is streamlined or related to every time frame, right? So if you are on 15 minutes time frame, it takes 15 minutes for a candle to what? Open and close, right? It takes 15 minutes for a candle to open and close. Then it helps you in your market analysis. Okay, so let's go to candlestick chart. and formation of candlesticks. So there are four prices that makes a candle, which means that in every time frame, these four prices must occur before the market, before another session or another time frame opens. So let's say if you are trading every 1 hour, right? So let's say you are trading a 1 hour candle. Within that 1 hour, right? So within that 59 minutes, 59 seconds, all these four prices will show, which is the open price, the close price, the high, and the low. So all these four prices will show, right? So let's talk about the first price, which is the high. Now, this high is the highest price the market has gotten to before the end of the session or before the end of a particular time frame. Okay, that is the highest price. So let's say this price gets to 20 before moving down to 14, right? So it has got to 20. So 20 is recorded as what? The highest high it got to. Then the next one is what? We have the low. So we have the low also, and when we are talking about the low, this is what? The lowest price. Do you have the opening price? What is the opening price? That is the initial price. That is the first price market will get to, or the candlestick will get to when opening or what? Closing. Then we have the closing price, right? So the closing price is where the market will, that's is showing the end of a particular what session. So let's say, for example, our market open at 2.00 and closes as what? 2.0050. That's 5 cents, right? I mean, 5 pips above, right? So what are we going to say? Sorry, 50 pips. So what I'm going to say, we say our price, what kind of candlestick is this? Candlestick is bullish because it opened at what? 2.0000 and closes at what? 2.0050. So this is telling us what a bullish candlestick. Telling us a bullish candlestick. Okay, let's continue. So this is just a candlestick construction. Like I said earlier, the real body is just it implies the distance between the what open price and the what the closing price, while the wicks it signifies the what the wick of the shadow typically the thin lines above. So we have the upper shadow and we also have the what the lower shadow. Any questions so far? Any questions so far? Can you all hear me? Hello? Please type on the comment section if you can hear me. Any questions so far? Okay, that's great. No questions. Okay, that's great. Okay, now let's continue. We have types of candlesticks formations, right? We have different types of candlesticks formations. Um, okay, so we are going to talk about these candlesticks formations. We have big white candle, blah blah blah. So let's talk about them one after the other. The first type of candlestick formation every trader should know, right? So these candlestick formations, they react at support zones or resistance zones. So if you don't know what support and resistance means, you can check some of our videos on YouTube at PU Prime Africa. You're going to see some of our videos there. Then you also some of the candles also shows you continuations. They shows you strength of a trend, telling you that oh okay, buyers are still in the market, continue buying, or there is a range. So market indecisions telling that oh, okay, there is a high level of indecisions in the market. Probably the market is still ranging or all that. So I'm going to talk about them and explain them one after the other. But me personally, I usually group them into two. Right, I group the first is to what ranging candles and what engulfing candles, right? So ranging candles and engulfing candles. Okay, so ranging candles, these are candles that has what that has a longer wick and a smaller body. Okay, what do I mean by wick? The thin line is always long and the body is always small. While engulfing candles, what do they do? They usually have what? Longer body and what? Smaller wick. Longer body and smaller wick. So let's talk about them. So the first candle we talk about is hammer, right? Hammer, they usually form like the shape of a hammer, right? And I can either be green or red, it doesn't matter. But what matters most is what they do. They have a small body and a what longer wick. What does it mean? It means that in a time frame, there were presence of sellers before buyers start coming in. before the end of that time frame. So what does it mean? Let me show you here. So let's say the market start coming down from here, and all of a sudden it started going up again. So this is the meaning of the hammer, right? Telling you that, what is it telling you? That in a particular session, there were what? There were what? Sellers at first in the market. Then when market goes to a support zone, what do we have? We now have what? Buyers pushing down the what? Pushing up the market. So that is how we have a what? A hammer. Okay, that is how we have a hammer. Okay, so that is how we have a what? A hammer, right? So we have the green and the red. It doesn't matter, right? So the meaning is just that in a support zone, buyers were what? Pushing down. Buyers pushes up an existing pressure of sellers. They resisted. That is, they pushed them back up. So the greener the candle is, the more it's telling you the pressure of buyers. Okay, so that is that on hammer. So let's continue. So the hammer you can see is a candlestick pattern formed the what? A short body and a what? Longer wick. And what did I tell you? Candlesticks that have short body and longer wick. What did I tell you? They are what? Ranging candles. They are ranging candles. They are candles that depict the presence of what? Buyers and sellers in a particular time frame. Okay, so they depict the presence of what? Buyers and sellers in a particular time frame. Okay, so that is that, and it's usually it's found at the bottom of the downtrend. Yes, you usually see them when the downtrend is getting over, when the downtrend is getting exhausted. So when the market is selling, when the selling pressure is much, and you now see buyers coming in, you now see it forming a thin line, then you know that, oh, okay, this is a what? This is a hammer, right? So that is that. You can see a good bullish candle following the hammer will be strong enough to drive the market price up as confirmation candle. So once the hammer happens, then we expect a what? A good bullish candle. So meaning that engulfing candle should follow it. We are going to talk about that one. So meaning that, after we have a candle that has a thin body and a smaller body and a longer wick, the next candle should be what? Candle that has a bigger body and no wicks at all, right? So that is what a hammer looks like, right? So the second one is what? Inverted hammer. Now, inverted hammer is usually found at support zone also. So it's just telling us that, oh, okay, there are some hidden pressure of sellers, but the inner strength of buyers can withstand it, right? So you can also find this in a support zone. And what did I tell you? Well, how does it form? They have thin line and a what? Thin wick. I mean, a smaller body and a longer wick. Okay, so it has a smaller body and a what? And a longer wick. So this type of candle, they are telling you that, oh, okay, there are presence of buyers in a particular region. And they are usually found in what? In a support zone. Right. So don't forget what type of candle can we find in the support zone. The first is what? Hammer. The second is what? Inverted hammer. So these are the two types of candle we found in the what? In a support zone. Okay. Now the other one is a what? Hanging man. The other one is what? Hanging man. So hanging man is always found at the top. So when it's just like when you find a hammer, but it's at the top, it's at a high price, at the resistance price. It's telling you that the pressures of buyers are at a point, but the sellers are still holding their ground, right? So the sellers are still holding their ground. That is what the hammer just implies, right? So it's telling you that, oh, okay, buyers are starting coming, they're moving the market, they're moving, they're moving the market like this, like this. They may not have market a thin line, then suddenly boom to the upside, right? So that is what we call a hanging man. Okay, so hanging man, they are there and they are showing us that, oh, okay, the pressure of a particular price at the top, and the buyers were trying to push the market above this price, but they could not. So it is when you find a hammer. But one thing I want to make you understand is what? A thin shadow and a smaller one, a longer shadow, a longer wick, and a smaller body. So the body is small, but the wick is what? The wick is high, right? So that is just an example of a hanging man. Okay. So so it indicates what? Seller's pressure in a buyer's territory. Yes. So the market might have been buying, buying, buy, right? Buy, right? Then it got to a certain level, it could not break above it. Then what happened? Sellers started coming into the market. So when you have this type of formation, you are what? Selling. Okay, you are selling. Okay, so that is that as an example of a hanging man. So the other one is a shooting star. This is just direct. When price start going up and seller start pushing it down. So you can call it rejection, you can call it a week, but there's something similar to all of them. They have a what? A longer wick and a smaller what? Body. So when you see that at the top, the body is small, but the wick is longer than the length of the body, just know that the next thing you're expecting is what? Is sellers, because it shows you the presence of what? Bearish sentiment. So this is just another example. Sorry, please. So this is just another example of what? Sellers in the market. Okay. So that is it. It has a smaller body, also, and a longer what? Upper wick. It's formed in an uptrend. So price is uptrended. It indicates that there was a significant sell-off during the session, telling you that the buyers were in the market, then the presence of sellers just caught up. So something like this, before the end of that time frame, we have something like this, then boom, then market starts booming down. So that is the work of what? Of sellers, right? In the very market. Okay, so let's continue. So the another type of candle that I want to talk about is the engulfing candle. When something engulfs, it means that what? It swallows, right? So this is just the two types of candle pattern formation when the new candle formed is higher, twice as bigger than the previous candle. It's called an engulfing candle. And this bullish, we have to have the engulfing candle, we have the bullish engulfing. This happens in the support area, telling you that what the presence of buyers, this type of candles, the buyers' pressure has what swallowed up the sellers, the previous candles, telling you that there is no argument, the buyers have taken over the market straight up. So it's just the two candle formations telling you a significant buying force in the seller's territory. This usually happens in a when market is going down. We just see this new candle is higher than the previous candle, swallow it up, or the size of it is twice as bigger than the previous candle. Just know that we are in what it is called a what? Bullish engulfing candle, right? So look at this. This is an example of a bullish engulfing candle. I know some of you might have seen this candle and you don't know what it is. So this is an example of what? Bullish engulfing candles, right? So we also have bearish engulfing candles. These candles also, you see them in a resistance zone, right? So this is when a bearish candle is as twice as the previous bullish candle. Why? When a bearish candle is as twice and as the previous bullish candle. Okay, so I that is what we call a bearish candle. So from here to here, okay, so you can see from high and market pushes down. So this is an example of a what? Bearish what? Engulfing candle. Okay, bearish engulfing candle. Okay, so we also have a piercing pattern. This candle is not usually common, but it usually happens when a candlestick closes 60% before the previous candle. Okay, when the present candle closes 60% below the previous candle, is called a what? A piercing candle, right? So it's not usually common. Now let's talk about doji. Mhm. So now a doji shows that in a Japanese um, time frame, donji means the same time. It usually means equilibrium. So this usually means the equal length between buyers and sellers, right? It shows that the equal strength between buyers and sellers, and it has a very, very small, the open and close is just equal. The open and close is what is equal. So that is just what doji means. And it's most important individual candlestick pattern, and you can also it tells you that the market is in a tight range. It's in a tight range. The strength of buyers and the strength of sellers are what are equal. So that is what doji means, right? So we have types of doji. We have long leg doji, dragonfly doji, gravestone doji. All these are examples of what? They are examples of doji. Now, another candle I want to talk about is three inside up, right? Three inside up. This candlesticks, is when we have first a bearish candle, right? So we have in a seller's territory. So the first candle came in, right? And it was just like 50%. Then the other candle what goes in and is higher than the previous candle, right? So this is called what? Three inside up. It's just like when the two present candle is higher and engulfs the previous candle. And this usually shows bullish bullish it shows bullish pressure, right? It shows bullish pressure. So that's that on three inside up. So we also have three inside down. This is usually found at a resistance point when we have a bullish engulfing candle. Then the next two candles that follows it is a bearish candle, and they are higher than the bullish candle. So this is just a what? A three inside down candlesticks pattern. Okay, so we have the evening star and the morning star. So how does the evening star occurs? When the evening stars occurs when we have a bullish candle, right? We have a bullish candle. The next is a what? A doji or a bearish candle. Then the candle that precedes is a what? Bearish candle. So it's just three candlestick formations. We have a bullish, then we have a doji, or probably a indecision candle. That is candlesticks that has equal highs, and I mean the shadows are equal. Then the next engulfing candle is bearish candle. So this is called evening star. Then the other is a what? Morning star. Morning star is when we have two bearish candle and the next candle is an engulfing candle. So the next or the third candle has to be higher than the two previous candles. Okay, so when you see this type of candlestick pattern, you place an entry in those candlesticks pattern. Okay, so that's that on evening star and morning star. So we have tweezer top and tweezer bottom. So tweezer top, some people call it a railway track, right? When two candles has equal length. When two types of candle has what? Equal length is called the what? Tweezer, called the tweezer top. So when the two candles has equal length, then we know that it's called the what? Tweezer top. So this usually occurs, it signifies what? Bearish reversal pattern at the top of uptrend. So it signifies a bearish reversal pattern at the top of what? Uptrend with two Japanese candlesticks matching at the top. So that is that. Then the tweezer bottom also represents what? Bullish what reversal pattern. They are, don't forget I said they have what? They have equal lengths, equal highs, and equal lows. When you see this type of candle formation, then you know that yes, this is a what? Tweezer bottom. It shows total what? Reversal pattern. You usually see it in a downtrend, and it consists of two Japanese candle matching both of them. So these are also examples of what? Of candlesticks pattern that we have, right? So we also have a spinning top. Spinning top is when the small body is a candlestick with a what? Small real body and two longer shadows. Yes. So two longer upper wicks and lower wicks, but the body is a small. It's small. It looks like doji, but it is not a doji candle, right? So it's telling us that yes, there are presence of buyers and sellers, but the wicks are usually long, right? So they do not close at equilibrium, they do not close at real price, but the wicks are usually long. So we have a spinning top. We also have a what? Spinning. We have what? Spinning bottom. Then we have a harami. Now, harami is just two candlesticks pattern. It's when a candlestick is inside another candlesticks. Okay. So when let's say, let me give an example. So this is an engulfing, right? And this other candlesticks is inside this candlestick. Some people call it a pregnant, something like a pregnant baby. Okay, so when you see this type of candlesticks, just know that what a reversal is coming. Just know a reversal is what is coming. So you have bullish Arami, you also have the what? The bearish Arami. Okay, so I'm going to because on Friday we are going to do the practical aspect of it. Okay, so we're going to do the practical aspect of this, right? So I want to ask if we can, if you have any questions. Do we have any questions? So on Friday, when I do the practical aspect of it, we are going to understand better. So any questions, please, so far? Any questions? None. Okay. Any other question? Yes, Ms. Funke, please unmute yourself and ask your questions. Yes, the record is, yes, the recorded version is going to be sent to the group.
Good evening, sir.
Yes, good evening.
Hello, can you hear me?
Yeah, I can hear you.
Thank you for the class. Yeah, please, this around me, which one is bullish, which one is bearish? The
Okay.
color is confusing.
Oh, okay, thank you. So the bullish harami, it usually occurs in an uptrend, right? So sorry, the bullish harami,
This bullish one.
yeah, no problem. So the let's start. So the how to identify them is the bigger candle, right? So if this one is in a downtrend, if the down candle, if this is because this represents a bearish candle, right? So if this bearish candle occurs in a downtrend and the next bullish candle that is inside it is a bullish candle, so it's called a bullish what? Bullish Arami. Okay, and this one is called a what? Bearish what? Harami, because this happens in an uptrend, right? So when we have a bullish engulfing candle and the next candle is spinning top, is inside this at a resistance point, it's called a bearish Harami. So it is written here, bullish and what? Bearish. Hope you understand that.
Okay, so this black one is a red candle, Abby?
Yes, this black one is a red candle.
Oh,
Then this white one is a green candle. This is a green candle. This is a red candle.
okay. Thank you.
You're welcome. Any other question, please? Yeah, I'm going to send the recording so you can watch over and over again. Okay, in case of no questions, thank you very much. We see you on Friday where we display the practical aspect of it. You can watch this video on YouTube and also follow us on our YouTube page at P Prime Africa. You watch a whole lot of videos that we've done so that you can have good understanding about forex trading. My name remains Michael. Thank you very much and have a wonderful day.
Thank you so much.